Unveiling the art of balance, determining the appropriate level of leverage in your portfolio. In the intricate realm of investing, the concept of leverage introduces a potent yet double-edged sword. While judicious use of leverage can amplify returns, it also heightens risk, demanding a delicate balance that hinges on meticulous analysis and thoughtful decision-making. Navigating the terrain of leverage requires investors to grapple with questions that extend beyond mere numerical calculations. Delving into the nuances of risk tolerance, investment goals, and market conditions. Understanding leverage. Leverage, in financial parlance, refers to the use of borrowed capital to magnify the potential return on an investment. While the prospect of enhanced gains may be alluring, it comes hand in hand with an elevated level of risk. Investors can employ leverage in various forms, such as margin trading, options, or leverage exchange-traded funds, ETFs, each presenting distinct considerations for those seeking to optimize their portfolios. The risk-return trade-off. Determining the appropriate level of leverage hinges on a fundamental principle in investing, the risk-return trade-off. Investors must weigh the allure of augmented returns against the increased risk exposure that accompanies leverage. Consider a scenario where an investor employs a 2x leverage on an investment. While potential gains are doubled, so too are potential losses. Striking the right balance necessitates a nuanced understanding of one's risk tolerance, time horizon, and investment objectives. Risk tolerance and time horizon. Investors must conduct a thorough self-assessment of their risk tolerance before venturing into the realm of leverage. While some individuals may be comfortable with the prospect of heightened volatility and the potential for larger swings in portfolio value, others may prefer a more conservative approach. A critical component of this assessment is aligning one's risk tolerance with their investment time horizon. Long-term investors may be better positioned to weather short-term fluctuations induced by leverage, while those with a shorter time horizon may find the amplified volatility unsettling. Market conditions and economic indicators. Astute investors recognize that the appropriateness of leverage is not a static concept but one that fluctuates with market conditions. During periods of economic stability and low volatility, leverage may seem more palatable as the risk of severe market downturns diminishes. Conversely, in times of economic uncertainty or heightened market volatility, investors may opt for a more conservative approach, reducing leverage to shield their portfolios from amplified risk. Consider the example of an investor during an economic expansion characterized by robust growth. This investor might be more inclined to leverage their portfolio, anticipating that the favorable economic conditions will bolster their returns. Conversely, during a recession, the same investor might reconsider, dialing back leverage to mitigate potential losses amid heightened market turbulence. Comprehensive portfolio analysis. Determining the appropriate level of leverage necessitates a comprehensive analysis of the entire portfolio. Investors should scrutinize the existing risk profile of their investments, identifying sectors or assets that may be more or less conducive to leverage. Diversification, a cornerstone of sound investment strategy, becomes even more crucial in the context of a leveraged portfolio. Spreading risk across different asset classes can help mitigate the impact of adverse movements in any single investment. Additionally, investors should be attuned to correlations between assets in their portfolio. Understanding how different investments move in relation to each other under various market conditions is integral to managing risk effectively. Leverage applied to a diversified portfolio can be more resilient in the face of market turbulence compared to concentrated positions. Stress testing and scenario analysis. The prudent investor employs stress testing and scenario analysis to gauge the resilience of their leveraged portfolio under adverse conditions. By simulating various market scenarios and stress testing the portfolio's performance, investors can gain insights into potential vulnerabilities. This proactive approach enables investors to make informed decisions about adjusting leverage levels based on a thorough understanding of how their portfolio might fare under different circumstances. Consider an investor who has leveraged their portfolio during a period of economic stability. Engaging in scenario analysis, they simulate a market downturn to assess the impact on their leveraged positions. Armed with this information, the investor can make proactive adjustments, such as reducing leverage or reallocating assets, to fortify their portfolio against potential downturns. Continuous monitoring and adaptability. The dynamic nature of financial markets underscores the importance of continuous monitoring and adaptability when it comes to leverage. Investors should not view leverage as a static tool but rather as a variable that requires ongoing assessment. Regular reviews of economic indicators, market trends, and changes in personal circumstances can inform decisions about adjusting leverage levels to align with evolving conditions. In the ever-evolving landscape of investing, the ability to adapt and recalibrate is a hallmark of successful portfolio management. Investors who recognize the fluidity of market dynamics and approach leverage with a discerning eye are better positioned to optimize their portfolios while mitigating the inherent risks. Conclusion. Determining the appropriate level of leverage in a portfolio is a nuanced endeavor that demands a judicious blend of quantitative analysis, self-awareness, and a keen understanding of market dynamics. Leverage, when wielded with care and precision, can enhance returns and unlock new avenues for portfolio growth. However, it is not a one-size-fits-all solution. The optimal level of leverage varies from investor to investor and evolves with changing market conditions. As investors embark on the journey of incorporating leverage into their portfolios, they are well advised to tread thoughtfully. Balancing the allure of amplified returns with a measured recognition of the associated risks. In this delicate dance, the art of balance emerges as the guiding principle, steering investors toward a harmonious integration of leverage within their broader investment strategy.